Here are 7 reasons why margin investing with Yieldmax ETFs isn't as risky as you think. Yieldmax dividends and margin helps us earn over $250,000 per year in dividends, as you can see below, and our performance value shows that we're beating all the indexes using margin and Yieldmax. We're up 10.6% for the year. The S&P's up 7, the Nasdaq's up 6, the Dow's up 1, and the Russell's down 1. I know this sounds like a broken record that we're beating the indexes with this approach, but it's true, and we're living the FIRE lifestyle, which means financially independent, retire early. If you need help doing the same, email me for my e-guides at aikentod48@gmail.com. The first reason why using margin with Yieldmax funds isn't as risky as you think is because I buy low maintenance names. Now let's take Tesla for example. Tesla has been up recently. It's been on a tear. We've been making multiple videos about Tesla and the bottom. We've been rebalancing this fund because it's an index play and it was cheap. Well, now we're getting the rally, and so that helped us outperform the markets today. We're at 0.64 or about $6,000 when, if you look above, the Dow was up only 0.38, the Nasdaq was up 0.35, and the S&P was up 0.32. So us being up 0.64 with conservative funds like Tesla that have their upside capped and Defiance and Cornerstone, all these funds helped us outperform today, even with Tesla and these funds having their upside capped. And again, the reason why we outperformed is because we have this margin debt on. For every $1 you put in your account, you get $4 of purchasing power, and I just use a fraction of this margin purchasing power to get ahead. My dividends of around $250,000 will pay this debt back in around 1 year. I'm not worried about the interest on this debt because I negotiated it down twice. Many of the clients who bought my e-guides did the same thing. So we have this extra margin leverage on, and that's how we're outperforming, obviously. And even on down days, we outperform with this margin approach because the funds that we choose don't go up or down as much as the market, like Cornerstone and Defiance on a given down day. However, if you use a combination of all these funds, Yieldmax, Defiance, and Cornerstone, you can outperform. If you want to follow my portfolio, just click the join button on my wall, or I'll link that in the description below. So Tesla, yes, I own Tesla and we've been buying it on the dip, but its maintenance is 50% maintenance. I put most of my investments into Cornerstone, which is 30% maintenance. As you can see here, 30% maintenance. So this is how I use a substantial amount of margin and preserve my equity at the same time. It's because of low maintenance names. If you need help understanding maintenance, that's in my Volume 3 e-guide. So Cornerstone, it's low maintenance. That's why I put so much of my money in Cornerstone. And Defiance and Yieldmax are 50% maintenance, so I have less of my dollars in them. However, if you use the right combination of these funds, you can outperform on most days. So again, low maintenance names help us not only withstand margin calls when the market falls, we can withstand over 20% corrections and still withdraw freely out of our account. But low maintenance names also mean that they are inherently less risky. The lower the maintenance, usually the lower the volatility of that fund. So I put most of my money in Cornerstone, again, for that low maintenance. And also that preserves so much of my available for withdrawal that I can use more margin, okay, and then not have the risk of a margin call because my available for withdrawal is so high because of that low maintenance. And again, Yieldmax has high maintenance. You can go to other brokers who have lower maintenance, but what do I always say at this juncture? They might not have the special drip for Cornerstone. Cornerstone is a 4-star fund with the 30% maintenance, as I just described to you. It also has a 21% dividend, and it drips that 21% dividend down at the NAV for free money every month. Just make sure you factor back in dividends and drips when you look at a Cornerstone chart. Please don't give me comments and say that Cornerstone goes sideways to down over time. Why would you buy this fund? You have to time it between its rights offering. Also, Discord access is free when you buy my e-guide. So this is our Discord chat room where we have almost 1,000 members here pursuing the FIRE lifestyle, and we give you the rights offering announcement here in Discord. So we update you of these moves in Cornerstone as well as whatever else is happening with Yieldmax, Defiance, Bitcoin, etc. We have tons of channels here for your leisure. And again, if you ever have questions on how to use margin in your brokerage account, you can consult them at any time. Of course, you can call me as well. My phone number is also free with my e-guides. When you email me requesting information about my e-guides, I'll email you back a standard template that I send everyone that usually says something like, here is more information on my e-guides. Sometimes I answer your emails right away. Sometimes it takes me an hour or two just because I have so many requests. So just please bear with me. The second reason why using margin with Yieldmax investments isn't as risky as you think is because you have to buy sideways moving names to minimize volatility in your account. Most of the funds in my account move sideways to down, and that's a good thing because they limit volatility in my account. As you can see by Cornerstone's 10-year chart, it goes sideways to down over time. This is perfect for me because you need sideways moving names when you're in margin. I don't like surprises in my account, and I like to minimize volatility in my account. So having a bunch of names that go sideways like Defiance, Cornerstone, some Yieldmax names, even PFFA. My mentor, Jay Hatfield, taught me about PFFA. It goes sideways. I put a bunch of my money in PFFA to start because the maintenance was so low. However, PFFA crashed harder than Cornerstone did during the Corona crash, so I prefer Cornerstone as my main anchor, plus it has a much bigger dividend than PFFA. These sideways moving vehicles not only minimize volatility in my account, but they pay my bills while paying down my margin. So if I earn $20,000 in income and I have $5,000 in bills, then I net $15,000, which pays down my margin debt, and that grows my account by $15,000. Unlike with credit cards, when you pay back your credit card, your balance just goes to zero and your account does not grow. But with real estate or a brokerage account, when you pay your debt back with dividends, your debt goes away and your account value grows by that equivalent amount. The third reason I have for you all is that losses with margin are not magnified like with short selling. This is the big fear I think everyone has about margin. They think that if you have all this margin debt, if you fall, this is going to grow. Your losses are going to be magnified. But that's not how margin works. This $345,000 that I have invested in my account, if those positions fall, this margin position does not grow. Okay, so it's not like short selling again where it goes against you and you have to cover if you're wrong on your short position. This is margin debt, which is a different kind of debt, and it does not change if you have losses occur in your account. So margin investing, if you have small amounts of margin, there's almost no risk to margin investing because there's no way you can get into a margin call if you only have $1,000 or $2,000 of margin. So the question is, how much margin can you use before you're in a margin call? I like to use only a fraction of my purchasing power again so that I can withstand over 20% corrections in the market and still withdraw freely out of my account. You can do anything with margin debt. Even though I'm in this debt, I can swipe my E-Trade credit card and go wherever I want in this world. I can buy cars, clothes, shoes, whatever I want with margin debt. And again, when the market falls, your margin debt does not grow. Yes, if you have $500,000 in your account and you have $300,000 of margin debt, you need to factor it in as if you have $800,000 invested. However, what's a 10% correction on $800,000? 80. What's 20%? 160. So I can still withstand over 20% corrections in the market and still withdraw freely out of my account. So again, your margin debt does not increase when losses occur in the market. Your leverage increases when you have margin debt on, but if you use a small amount of leverage and then your dividends pay that back, your leverage goes away the next month. So I really don't understand the fear everyone has for margin investing. The fourth reason I have for you all is that your broker sells for you, okay? So even if you're in a market crash and you have this margin debt running, if the market falls enough, your broker will sell these positions for you and potentially limit your losses. And they usually don't sell for you right away. They give you 1 to 7 days to pay your margin. And if you're in a margin call by $1, you have to pay $1. And what I did to get out of margin calls was I just let the market turn around during Corona. And if you get into another margin call after that, it'll give you another 7 days to pay again. The clock keeps restarting. So these margin calls aren't as scary as you think. They help you in a down market. They're usually minimal calls when you do have them. They're, just by $1 or $5, whatever it is that you're in a margin call by. Again, your margin debt does not grow when you're in a downturn. So these margin calls are usually minimal. They give you 7 days to get out of it. The market could take you out of a margin call for you. And if your broker sells those funds for you, well, then your available withdrawal rises again. You can always just buy the dip once again. Point number 5. And I just alluded to this in point number 4, but obviously if you use small amounts of margin, there is no risk. My dividends of around $250,000 will pay this back in around 1 year, so my leverage goes away once my dividends pay this back. So the question becomes, how much margin do you use and what do you buy with it? And that's in my Volume 3 e-guide if you have questions on how to use margin. Number 6, there are no credit checks when using margin, so you don't have to qualify for this debt. You don't have to apply for it. It's automatically granted to you when you open a brokerage account. At E-Trade, for every $1 you put in, you get $4 of purchasing power after $25K. With other brokerages, you can have less in your account and still get 4 times purchasing power. So again, there are no credit checks. You can click sell at any time with this margin debt and it is gone. If it doesn't show up on a credit check to a banker, this allows you to get more loans without them seeing your margin debt. This is how I really level up in my account and live the fire lifestyle. Not only do I use margin for my loans, but I use SBA loans, personal loans, housing loans, car loans, whatever you want. Your dividends qualify you for loans, unlike with trading gains, which don't qualify you for loans. Banks will not accept trading gains because they're too up and down. Plus, 90% of traders can't even beat the market. So you might as well buy the indexes and buy things with dividends because that's what qualifies as income to banks, which helps you really live the fire lifestyle and level up your account with loans and buy a house, buy a car, which you need with a pay stub. So if you want to live free from a 9 to 5, you need to explore dividends And if you use margin, there is no credit check, so you can use this extra debt to get more dividends, qualify for the income without getting hurt on a credit check. Lastly, you can hedge your margin with short options, okay? I use put options to hedge my positions. I also have other short vehicles that I use. If you need help insuring your portfolio with options, see my Volume 3 e-guide. I have an insurance section in there that you can find whenever you need it. I don't need to short because my available withdrawal is so high, but I do keep on crash insurance just in case. I can withstand over 20% corrections and withdraw freely out of my account, as I've been saying, but I also keep on $100 to $200 of short option crash protection just in case there are any surprises in my account. So if we had a 30 to 40% correction overnight, I would potentially make more money on my short options than I would lose in my account. So that'll do it for the video, everyone. If you need more help doing what I'm doing, email me for my e-guides at aikentod48@gmail.com. When you buy my e-guides, Discord access is free for life, as well as my phone number, so just keep this in mind. Also, if you want to follow my portfolio to see how I'm getting this outperformance in the market, you can click the join button on my wall, or I'll link that in the description below. Please don't forget to like this video, as it does help the algorithms push my videos out to more people, and I'll talk to you soon, everyone. Thanks.